pipe. Pipe. There is a foundational deception at the heart of modern finance, an idea so pervasive, so deeply embedded in the consciousness of every ambitious individual, that to question it feels like an act of heresy. It is the silent, unquestioned assumption that the path to wealth is paved with accurate predictions. That the primary skill of the successful investor, the elite executive, the master strategist, is the ability to gaze into the murky future and correctly forecast events, to know which way the market will turn, which industry will be disrupted, which product will capture the public's imagination. The entire edifice of financial media, from the breathless pronouncements on cable news to the dense chart-filled reports of Wall Street analysts, is built upon this single, seductive premise. Someone, somewhere, knows what is going to happen next. And if you are smart enough, or quick enough, or have access to the right information, you can know too. This belief system powers a multi-trillion-dollar global industry. It fuels the ambition of millions, and according to the man who has compounded wealth more successfully than any other human in history, it is a complete and utter illusion. Warren Buffett's $90 billion fortune was not built on a single successful prediction. It was built on the systematic, ruthless, and unwavering rejection of prediction itself. His entire cognitive operating system, the very architecture of his thought process, is designed not to forecast the future, but to render the future irrelevant. He is not playing the game of foresight. He is playing a different game entirely, a game of preparation, of insulation, of building a fortress of rationality so robust that it can withstand the inevitable, unpredictable storms of the global economy. To the aspiring elite, this is a profoundly unsettling concept. It challenges the very nature of what they believe to be a high-value skill. We are taught to admire the visionary, the pundit who called the last crash, the analyst whose stock picks doubled in a year. We are conditioned to seek out certainty in the form of a forecast. But Buffett understands a truth that is both terrifying and liberating. The future is, and always will be, fundamentally unknowable. And any strategy that relies on predicting it is, by definition, a strategy built on a foundation of sand. The financial industry's obsession with prediction is not an accident. It is the natural and highly profitable exploitation of a deep-seated flaw in the human brain. Our minds are not truth-seeking machines. They are survival machines, hardwired over millennia with cognitive shortcuts and biases that were essential for navigating the dangers of the Pleistocene but are catastrophic in the complex, abstract world of modern markets. The most powerful of these is the narrative fallacy. We are storytelling creatures. We crave simple, linear, cause-and-effect explanations for complex, random events. A stock goes up, and we immediately construct a narrative. The brilliant CEO unveiled a new product, and the market recognized its genius. A stock goes down. Fears of a recession spooked investors, leading to a sell-off. These stories are comforting. They give us an illusion of understanding, of control. The financial news media is, in essence, a high-budget, perpetual storytelling machine, churning out thousands of new narratives every single day to explain the meaningless, random fluctuations of the market. The problem, as Buffett recognized decades ago, is that these stories are almost always written in retrospect. They are neat, tidy explanations for a past that has already happened. And they give us the disastrously false confidence that we can apply the same simple logic to predict the future. We see a pattern, and our brain's pattern recognition software, the same software that helped our ancestors spot a predator in the tall grass, screams at us that the pattern will continue. This is amplified by another powerful cognitive bias: overconfidence. Study after study has shown that humans are chronically overconfident in their own abilities and the accuracy of their own judgments. We believe we are better than average drivers, have a better than average sense of humor, and, most dangerously, have a better than average ability to predict the future. When an analyst in a sharp suit appears on television and confidently declares that the market is headed for a 10% correction, our brains are not wired to critically assess the statistical probability of his claim, which is statistically indistinguishable from a coin flip. Instead, we are wired to respond to the social cues of confidence and authority. His certainty becomes a substitute for evidence. Wall Street, at its core, is a machine for monetizing this overconfidence. It sells predictions. It sells forecasts. It sells the illusion that the chaotic, unpredictable future can be tamed and packaged into a neat, actionable report. Buffett's great heresy was to simply step outside this entire ecosystem. He famously stated, quote, "We've long felt that the only value of stock forecasters is to make fortune tellers look good." This is not a witty aphorism. It is the cornerstone of his entire philosophy. He understood that engaging in the prediction game is not just a waste of time, it is a cognitive trap. The moment you start trying to predict the short-term movements of the market, or the quarterly earnings of a company, or the next move of the Federal Reserve, you have already lost. You have subjected your rational mind to the fire hose of emotional, narrative-driven noise that is the daily financial news cycle. You have anchored your decisions to factors that are inherently unpredictable and ultimately irrelevant to the true long-term value of a business. Buffett's cognitive pivot was to change the fundamental question. The rest of the world was asking what is going to happen next. Buffett trained himself to ask a completely different set of questions. What is this business worth right now as a going concern? What is the probability that it will be earning significantly more money a decade from now, and how much of a discount to that underlying value is the market offering me today? Notice what is absent from these questions: any attempt to predict the macro environment, any attempt to forecast investor sentiment, any attempt to time the market. He replaced the fool's errand of prediction with the rigorous, disciplined work of valuation. He shifted his focus from the ephemeral narrative of the stock market to the bedrock reality of the business itself. This cognitive shift has a profound consequence that 99% of market participants fail to grasp. It liberates you from the need to be right all the time. The prediction game is a game of high frequency and low consequence, punctuated by moments of catastrophic consequence. You can be right 9 times in a row, making small gains, but a single unpredictable event, a black swan, a market crash, a technological disruption, can wipe you out entirely. The history of finance is littered with the graves of brilliant forecasters who were right for years and then were carried out on a stretcher. Their predictions were correct, but their timing was off, or they used too much leverage, and a temporary, unpredictable downdraft became a permanent financial death. Buffett's approach, in contrast, is a game of low frequency and high consequence. He doesn't need to make hundreds of decisions. He needs to make a handful of truly great decisions over a lifetime. And the only way to do that is to have a system that protects him from the catastrophic cost of being wrong. A system that doesn't require him to predict the future, but instead insulates him from its inherent unpredictability. That system, the central gear in the entire cognitive engine of Berkshire Hathaway, is the margin of safety. It is the most powerful mental model in the arsenal of the value investor, and it is a concept that extends far beyond the realm of finance into a universal framework for making high-stakes decisions under conditions of uncertainty. To truly understand the margin of safety is to rewire your brain, to abandon the seductive but bankrupt religion of prediction, and adopt a new, more powerful creed, a creed of humility, rationality, and profound, unshakable patience. It is the operating system for neutralizing risk and transforming the world's uncertainty from a terrifying threat into your single greatest opportunity. The journey to installing this operating system begins with a radical redefinition of 2 of the most fundamental concepts in finance: value and price. For the average investor, these 2 words are functionally interchangeable. The price of a stock on their screen is its value. But for Buffett, they are 2 completely different things, as different as reality and perception, as substance and shadow. Understanding this distinction is the first pillar in the architecture of the margin of safety. It is the bedrock upon which the entire fortress of rational decision-making is built. Imagine you are not buying a stock, a flickering green or red number on a screen represented by a three-letter ticker symbol. Imagine you are buying a private business in your town, say, the most profitable and well-run apartment building. When you consider buying this building, what questions do you ask? You would first want to know how much cash it generates. How many units are there? What is the average rent? What are the expenses? The property taxes, the maintenance, the insurance, the management fees? From this, you could calculate its net annual cash flow, the actual, tangible money the owner gets to put in their pocket at the end of the year. Let's say, after all expenses, the building generates $100,000 in cash profit per year. Now the next question is, what is a reasonable price to pay for that stream of income? You might decide that you want a 10% return on your investment. In that case, you would be willing to pay $1 million for the building. $1 million investment that generates $100,000 a year is a 10% yield. This $1 million figure is your calculation of the building's intrinsic value. It is a number derived from the fundamental economics of the asset itself, its ability to generate cash. It has nothing to do with what other people are thinking or feeling about real estate that day. It is an attempt to pin down economic reality. Now imagine there is a marketplace next door where the current owner of this building, a very peculiar fellow named Mr. Market, comes to you every single day and offers to either buy your share of the building or sell you his. Some days, Mr. Market is euphoric. He's read a newspaper article about how real estate is the best investment on the planet, and he comes to you, practically shouting with excitement, offering to sell you his half of the building at a price that would value the whole enterprise at $2 million. On this day, the price is $2 million, but you know from your own careful calculations that the intrinsic value is only $1 million. The price is double the value. You would, of course, politely decline his offer. You might even offer to sell him your half at his ridiculous price. Other days, Mr. Market is in a deep, dark depression. He's heard rumors of a new apartment complex being built across town, and he's convinced that real estate is doomed. He comes to you muttering about an impending crash and offers to sell you his half of the building at a price that values the whole enterprise at a mere $500,000. On this day, the price is $500,000. But you, armed with your knowledge of the building's cash flows, know that its intrinsic value is still $1 million. The price is now half of the value. This is the moment of opportunity. This is the moment you act. This simple parable contains the entire conceptual foundation of Buffett's philosophy. A stock is not a lottery ticket. It is not a piece of paper to be traded based on squiggly lines on a chart. It is a fractional ownership interest in a real business. The goal of the intelligent investor is to calculate the intrinsic value of that business, the equivalent of the apartment building's $1 million value, and then to wait, with infinite patience, for the manic depressive Mr. Market to offer a price that is significantly below that value. This concept of intrinsic value is the first pillar of the margin of safety. It is the anchor to reality in a sea of emotional madness. But how is it calculated? For Buffett, the theoretical definition is simple. Intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. In essence, it's the same logic as the apartment building. You must forecast the cash flows the business will generate from now until Judgment Day, and then discount those future cash flows back to their present value. The word forecast here might seem to contradict the idea of rejecting prediction, but this is a critical distinction. Buffett is not forecasting the stock price, the economy, or interest rates. He is attempting to forecast the long-term operational performance of the business itself. And, crucially, he only attempts this for a very specific type of business, one that is simple, understandable, and has a consistent and predictable operating history. This is where the concept connects to another of his core mental models, the circle of competence. You cannot calculate the intrinsic value of a business you do not fundamentally understand. If you don't know the industry, the competitive landscape, the durability of its products, you cannot with any confidence predict its future cash flows. This is why Buffett has famously avoided most technology companies for decades. It's not that he thought they were bad businesses, it's that he felt they were outside his circle of competence, and therefore, their long-term future cash flows were too uncertain for him to calculate a reliable intrinsic value. He would place them in his too hard pile. An intelligent investor, therefore, must be a business analyst first and a security analyst second. They must dig deep into the company's financial statements, the income statement, the balance sheet, the cash flow statement, and treat them not as a set of numbers to be plugged into a formula, but as a detailed story about the health and performance of the business. They must look for a long history of consistent profitability, strong returns on capital, and manageable levels of debt. These are the hallmarks of a high-quality business, the type of business whose future is at least partially knowable. The calculation itself can be complex, and there are many models, like the discounted cash flow (DCF) model, that attempt to formalize it. But for Buffett, the precision of the number is less important than the principle. He often says, "It's better to be approximately right than precisely wrong." He is not looking for a business that is worth $103.50 a share and is currently trading at $100. He is looking for a business that he can confidently say is worth at least $100 a share and is trading at $50 or $60. He is looking for the obvious. The act of calculating intrinsic value, even if the final number is just a rough estimate, is a profound act of cognitive discipline. It forces you to divorce your analysis from the prevailing market narrative. It forces you to think like an owner, not a speculator. It anchors your mind to the fundamental economic reality of the business. This anchor is absolutely essential, because without it, you are completely at the mercy of the second fundamental force in the market, the wild, irrational, and often insane fluctuations of price, dictated by the whims of Mr. Market. This is the second pillar in the architecture of the margin of safety. If intrinsic value is the bedrock of reality, price is the ephemeral shadow cast by the collective psychology of the crowd. Understanding the nature of this shadow, and more importantly, understanding the deeply flawed psychological engine that creates it, is the key to transforming market volatility from a source of fear into a source of opportunity. Mr. Market, the allegorical business partner that Benjamin Graham introduced and Buffett has championed throughout his career, is the perfect personification of the stock market. He is your partner in a private business. Every day he shows up and offers a price at which he will either buy your interest or sell you his. The most important thing to remember about Mr. Market is that he is there to serve you, not to guide you. If his daily quotes are helpful, you can use them. If they are not, you are free to ignore them completely. You are not obligated to transact with him. This simple idea is one of the most powerful psychological tools an investor can possess. The average person sees the stock market as a source of information, a guide. When the price of a stock they own goes down, their immediate emotional reaction is fear. They interpret the falling price as a signal that something is wrong, that their initial judgment was flawed. The falling price becomes a verdict. They feel compelled to act, to sell, to cut their losses, to follow Mr. Market's lead. When the price goes up, they feel euphoria and greed. The rising price validates their genius. They are tempted to buy more, to chase the momentum, convinced that Mr. Market knows something they don't. Buffett's mental model completely inverts this relationship. He does not view Mr. Market's quotes as a source of information about value, but as a source of opportunity to exploit a discrepancy between price and value. Mr. Market's mood swings are not a guide to be followed. They are a behavioral flaw to be weaponized. To do this, you must first deconstruct the psychological states of Mr. Market. His mind is not a rational, calculating machine. It is a bubbling cauldron of the most potent human emotions and cognitive biases. In his manic phases, Mr. Market is in the grip of extreme greed, FOMO, fear of missing out, and social proof. He sees other people getting rich, and he cannot stand to be left behind. He falls for compelling narratives, the dawn of a new technological era, a revolutionary product, a company that can't lose. In these moments, he is completely blind to fundamental value. The story becomes more important than the numbers. He will pay any price, no matter how absurd, to be part of the excitement. This is the state of a market bubble. During these times, Mr. Market will come to you and offer to buy your shares at prices that are far, far above your calculation of their intrinsic value. The rational investor, anchored to their valuation, recognizes this for what it is, an opportunity to sell a $1 bill for $2. They feel no temptation to join the party. Their discipline is rooted in the cold, hard math of their value calculation. In his depressive phases, Mr. Market is consumed by fear, panic, and a catastrophic loss of perspective. A negative news event, a weak earnings report, a recession, a geopolitical crisis triggers a cascade of selling. Social proof works in reverse. Everyone else is selling, so he must sell too. The narrative flips from boundless optimism to hopeless despair. In these moments, he forgets that he owns pieces of real, productive businesses. He sees only falling prices and imagines they will fall forever. He is willing to sell you his shares at prices that are a fraction of their underlying value, simply to make the pain stop. This is the state of a market crash. The rational investor, again anchored to their valuation, recognizes this for what it is, the opportunity of a lifetime. It is a fire sale on the world's greatest businesses. While others are panicking, the intelligent investor feels a sense of growing excitement. Their mindset is, as Buffett has famously said, be fearful when others are greedy, and greedy when others are fearful. The key to maintaining this psychological equilibrium is the unwavering belief in your own calculation of intrinsic value. That number, that bedrock of reality, is the only thing that can protect you from the emotional contagion of the crowd. Without it, you are just as susceptible to Mr. Market's mood swings as everyone else. You will be swept up in the euphoria and crushed by the despair. The entire game, then, is a waiting game. It is the discipline of doing the analytical work to determine value and then patiently waiting for the inevitable moment when Mr. Market's emotional state creates a wide gap between that value and the price he is offering. This gap, this chasm between reality and perception, is the third and final pillar of the system. It is the margin of safety itself. It is the operational trigger that turns all this theory into a concrete, wealth-creating action. Benjamin Graham, Buffett's mentor and the father of value investing, described the margin of safety as the, quote, central concept of investment. In its simplest form, it is the principle of buying a security for significantly less than you believe it is worth. If you have calculated that a business is worth $100 per share, buying it at $95 does not provide a margin of safety. It is too close to your estimate. A small error in your calculation, a slight downturn in the business, could wipe out your potential return. But buying that same $100 business for $50, that is a margin of safety. This $50 buffer is not just a potential for profit, it is a cushion against adversity. It is the shock absorber that protects you from the bumps and potholes of the real world. Buffett has often compared it to building a bridge. If you need to drive a 10,000-pound truck over a bridge, you don't build a bridge that can hold exactly 10,000 pounds. You build a bridge that can hold 15,000 or 20,000 pounds. That extra capacity is your margin of safety. It protects you against unforeseen stresses, hidden flaws in your materials, or errors in your engineering calculations. The margin of safety in investing serves the exact same purpose, but it functions on two distinct levels, as a mathematical buffer and as a psychological buffer. First, let's deconstruct its function as a mathematical buffer. The future is uncertain. Your calculation of intrinsic value, no matter how detailed and rigorous, is still just an estimate. It is a guess about the future, albeit an educated one. You will make mistakes. You might overestimate a company's future growth rate. You might underestimate the threat from a new competitor. Management might make a disastrous acquisition. A new technology might disrupt the entire industry. The economy might fall into a deep and prolonged recession. The margin of safety is your protection against all these unknowable risks. It is the explicit acknowledgement of your own fallibility. When you buy a stock at a 50% discount to its intrinsic value, you are creating a massive cushion for error. The business does not have to perform perfectly for you to make a good return. Its growth can be slower than you expected. It can face new competition. It can suffer through a recession. And despite all of this, because you bought it so cheaply, you can still come out ahead. The margin absorbs the negative impact of these unforeseen events. It is the primary tool for risk management. For most of Wall Street, risk is defined as volatility, as measured by the Greek letter beta. A stock that bounces around a lot is considered risky. A stock that is stable is considered safe. Buffett thinks this is absurd. For him, risk is not volatility. Risk is the permanent loss of capital. A stock can be extremely volatile in price, but be a very low-risk investment if you bought it at a massive discount to its intrinsic value. Conversely, a stable blue-chip stock can be an extremely risky investment if you buy it at a price far above its intrinsic value. The risk is not in the stock, it is in the price you pay for it. The margin of safety, therefore, is the only true measure of risk. The wider the margin, the lower the risk. The second, and arguably more powerful, function of the margin of safety is as a psychological buffer. This is what separates the professional from the amateur. Investing is not a game played on a spreadsheet. It is a game played in the mind, under conditions of extreme emotional pressure. The greatest enemy of the investor is not the market, it is themselves. The margin of safety is the antidote to the two emotions that destroy more wealth than anything else: fear and greed. When a market is crashing, and the stock you own has fallen by 30, 40, or even 50%, the natural human reaction is terror. Your stomach churns. You feel an overwhelming urge to sell, to make the pain stop. The only thing that can counteract this primal fear is the cold, intellectual knowledge that you have a massive margin of safety. If you calculated the value to be $100 and you bought it $50 and the price now drops to $30, you are not gripped by fear. You are gripped by a sense of profound opportunity. You are not thinking, "I've lost 40% of my money." You are thinking, "The market is now offering me a 70% discount to value. I should buy more." This ability to be an enthusiastic buyer when prices are collapsing is the single greatest determinant of long-term investment success. And it is psychologically impossible without the anchor of a pre-calculated intrinsic value and a wide margin of safety. It is the source of the courage to act when others are paralyzed by fear. Conversely, when the market is in a state of euphoria and the price of a stock has soared far above its intrinsic value, the dominant emotion is greed. You see your neighbors getting rich, and you feel the powerful pull of FOMO. You are tempted to abandon your discipline, to chase the momentum, to believe that this time is different. The margin of safety acts as a brake on this destructive impulse. When the price of your $100 value stock hits $200, your system doesn't scream, "Buy more," it screams, "Sell." The absence of a margin of safety provides the discipline to resist the siren song of the bubble. It allows you to stand apart from the crowd, to remain rational when everyone around you has lost their minds. This three-pillared cognitive architecture, understanding value as a bedrock reality, understanding price as emotional noise, and using the margin between them as a mathematical and psychological buffer, is the complete operating system. It is a comprehensive framework for decision-making under uncertainty. It is robust, it is rational, and it has been proven to work for nearly a century. But knowing the theory is one thing. Putting it into practice, embedding it so deeply into your cognitive habits that it becomes automatic, requires a specific set of mental tools. These are the applications, the subroutines, that run on top of the margin of safety operating system. The first and most critical tool is the practice of inversion. The human brain has a natural tendency to think in a forward direction. We ask, "How can I achieve success?" We brainstorm all the things that could go right, all the ways our investment thesis could play out perfectly. This is a deeply flawed way to approach a complex problem. The great mathematician Carl Jacobi famously said, "Invert, always invert. Charlie Munger, Buffett's longtime partner, has made this the cornerstone of his approach to thinking. Instead of asking, "How can this investment succeed?" the inverted question is, "How can this investment fail?" Instead of focusing on the upside, you start by obsessively focusing on the downside. You conduct what is known as a pre-mortem. You imagine that it is 1 year in the future, and the investment has been a complete catastrophe. Then, you tell the story of how it happened. What went wrong? Did a new competitor emerge with a better product? Did the CEO get caught in a scandal? Did a change in regulations destroy the company's profitability? Did the company's main product become obsolete? Was there a hidden flaw in the balance sheet that you missed? By starting with failure, you are forced to confront all the potential risks and weaknesses in your thesis head-on. This process is not about being pessimistic, it is about being realistic. It is a systematic way to identify the key variables that could lead to a permanent loss of capital. The margin of safety is the direct output of this inverted thinking. The size of the discount you demand is directly proportional to the number and severity of the risks you identify in your pre-mortem. If a business is incredibly stable, with a deep competitive moat and a long history of predictable earnings, your required margin of safety might be smaller. If a business is more cyclical or faces more technological threats, your required margin must be much, much wider to compensate for the increased uncertainty. Inversion forces you to look for what can go wrong, which is infinitely more important than fantasizing about what can go right. As Munger says, "All I want to know is where I'm going to die, so I'll never go there." The second tool is a relentless focus on building a more reliable estimate of intrinsic value. The entire system hinges on the quality of your V in the V minus P equation. If your value estimate is garbage, your margin of safety is an illusion. To make the value calculation more robust, Buffett adopted a technique from another legendary investor, Philip Fisher, known as the scuttlebutt method. Scuttlebutt is, simply put, investigative journalism applied to investing. It is the process of going beyond the financial statements and the official company presentations to gather on the ground qualitative information about the business and its competitive position. This means talking to as many people connected to the business as possible. Talk to customers. Why do they choose this company's products over the competition? How loyal are they? Talk to suppliers. Do they see the company's orders increasing or decreasing? How does the company treat its partners? Talk to former employees. What is the culture really like? Is management respected? Talk to competitors. What are this company's greatest strengths and weaknesses? Where are they vulnerable? This scuttlebutt process is not about finding hot tips or inside information. It is about building a rich, multifaceted, qualitative mosaic of the business that cannot be found in an annual report. It is about understanding the intangible factors that create a durable competitive advantage, the economic moat. Every piece of qualitative data you gather either increases or decreases your confidence in the company's ability to generate cash in the future. It reduces the range of uncertainty around your intrinsic value calculation. A more certain V makes your margin of safety more reliable. It is the intellectual grunt work that transforms a guess into a well-reasoned judgment. The third tool is the ruthless and disciplined use of the too hard pile. A direct consequence of the margin of safety operating system is the realization that you do not need to have an opinion on every company, or even most companies. The vast majority of businesses are simply too complex, too unpredictable, or too fast-changing to allow for a reliable calculation of intrinsic value. The aspiring elite often feel a pressure to be an expert in everything. They see a new, exciting industry, and they feel they need to have a take, an angle, a way to play it. This is a catastrophic error. Buffett's great intellectual advantage is not just the size of his circle of competence, but the ruthless efficiency with which he identifies what is outside of it. If he can't understand a business within a few hours of reading about it, it goes into the too hard pile. He does not waste a single moment of mental energy on it. This is not an admission of failure. It is an act of profound intellectual discipline. It is a filter that allows him to conserve his cognitive resources, for the few opportunities that are simple, understandable, and fall squarely within his circle of competence. The too-hard pile is arguably his most profitable asset. It is the repository of all the potential mistakes he has avoided. For every brilliant investment he has made, there are thousands of tempting but ultimately unknowable opportunities that he has had the wisdom to ignore. The margin of safety system only works if you apply it to businesses you can understand. The courage to say "I don't know" is the ultimate competitive advantage in a world that rewards false certainty. The final tool is the synthesis of all the others, the ability to recognize a fat pitch and act with massive, concentrated conviction. The margin of safety framework is not about diversification in the conventional sense. Modern portfolio theory teaches that you should spread your bets widely, owning a little bit of everything. The Buffett-Munger approach is the polar opposite. They believe that true risk reduction comes not from owning many things, but from deeply understanding a few things and buying them at a price that offers a massive margin of safety. Buffett uses the analogy of a baseball batter. An investor can stand at the plate and watch thousands of pitches go by, stocks trading at fair prices, stocks in industries they don't understand, complex situations with too much uncertainty. In investing, there are no called strikes. You can wait and wait and wait for the perfect pitch. A fat pitch is that rare, once-in-a-while opportunity where a wonderful business, a business you understand deeply, is offered at a ridiculously cheap price due to some temporary market panic or neglect. It is the intersection of a high-quality company and a massive margin of safety. When this happens, the system demands that you don't just take a small swing. You swing for the fences. This is the logic behind Buffett's famously concentrated portfolio. He doesn't want to own 50 mediocre ideas. He wants to own a handful of his best ideas, a handful of situations where he believes the odds are overwhelmingly in his favor. He uses his 20-slot punch card analogy. Imagine you have a punch card with only 20 punches on it for your entire investing life. With each investment you make, you use up a slot. This mental model forces an extraordinary level of discipline. You wouldn't waste a punch on a speculative 50-50 bet. You would wait for the near certainty, the true fat pitch. A classic example of this was Buffett's investment in American Express in the 1960s, during the salad oil scandal. A major customer of American Express's warehousing division, a company dealing in salad oil, was discovered to be a massive fraud. The company's tanks were mostly filled with seawater, not oil. When the fraud was exposed, Wall Street panicked. They assumed American Express would be on the hook for massive losses that could bankrupt the company. The stock price was cut in half. Everyone was selling. Buffett, however, did not panic. He applied his cognitive toolkit. He went into scuttlebutt mode. He went to restaurants and asked them if they were still accepting American Express cards and traveler's checks. He talked to bankers and merchants. He quickly realized that the scandal in the small warehousing division had absolutely no impact on the core, incredibly profitable businesses of the credit card and the traveler's checks. The company's brand and consumer behavior were completely unaffected. He calculated the intrinsic value of the core businesses and realized that, at the panicked price, he was being offered a massive margin of safety. The market was focused on the one thing that went wrong and was completely ignoring the powerful, durable businesses that were still intact. He recognized the fat pitch. And he swung hard. He invested 40% of his partnership's capital into American Express stock. It was a massive, concentrated bet. Within a few years, the market came to its senses, the stock price recovered and soared, and Buffett made a fortune. This was not a lucky guess. It was not a prediction. It was the systematic application of a cognitive operating system. He stayed within his circle of competence. He could understand the credit card business. He did the scuttlebutt to verify his thesis. He calculated the intrinsic value. He waited for Mr. Market's panic to create a massive margin of safety, and then he acted with conviction. This is the margin of safety in action. It is a complete system for thought and action. And its power is not limited to the world of investing. The margin of safety is a universal mental model, a framework for navigating uncertainty and building resilience in every domain of life. The aspiring elite are often obsessed with optimization. They want to operate at 100% capacity all the time. They fine-tune their schedules down to the minute. They push their bodies to the physical limit. They leverage their careers for the maximum possible short-term gain. The margin of safety framework teaches that this obsession with efficiency is, in fact, the riskiest possible strategy. A system that is perfectly optimized for a stable environment is incredibly fragile and will shatter at the first sign of unexpected stress. True resilience, true long-term success comes from building in slack, from creating buffers, from intentionally operating at less than maximum capacity. It comes from building a margin of safety into every aspect of your life. Consider your career. The hyper-specialist who has mastered one narrow, in-demand skill might be the highest earner today, but they have no margin of safety. If a new technology automates their skill, or if the economy shifts and their industry declines, they are left with nothing. The individual who builds a skill stack, who combines their core expertise with complementary skills in communication, management, marketing, or coding, has a massive career margin of safety. They are more adaptable, more resilient, and can pivot to new opportunities when the landscape changes. Their extra skills are a buffer against the uncertainty of the future job market. Consider your health. Many people live their lives right on the edge of their physical capacity. They burn the candle at both ends, surviving on minimal sleep, poor nutrition, and high levels of stress. They are operating with no margin of safety. The first unexpected shock, an illness, a period of intense work pressure, can push them over the edge into a state of burnout or chronic disease. The person who prioritizes 7 to 8 hours of sleep, who consistently eats well, who makes time for regular exercise, is not just being healthy, they are building a physiological margin of safety. They have the reserve capacity to handle stress, to fight off illness, and to perform at a high level over the long run. Their healthy habits are a buffer against the inevitable shocks and stresses of life. Consider your time. The modern executive's calendar is often a monument to false efficiency, packed back-to-back with meetings, calls, and obligations. This leaves zero room for deep thinking, for creativity, or for responding to unexpected opportunities. This is a schedule with no margin of safety. Warren Buffett's calendar, by contrast, is famously empty. He spends the majority of his day simply sitting in his office and reading. This is not laziness. It is a deliberate strategy. He has built a massive margin of safety into his time. This slack in his schedule is what allows him to think long-term, to avoid reactive decision-making, and to be fully available to act with speed and decisiveness when one of those rare fat-pitch opportunities comes along. An empty block of time on your calendar is a buffer against the urgent but unimportant, creating the space for the non-urgent but profoundly important. In every domain, the principle is the same. The rejection of prediction in favor of preparation, the embrace of buffers over brittle optimization, the humility to acknowledge that the future is unknowable, and the wisdom to build a system that is robust enough to thrive in spite of that fact. The margin of safety is not just a technique for buying cheap stocks. It is a philosophy for life. It is the cognitive operating system that allows you to navigate a world of profound uncertainty, not with fear, but with a quiet, rational confidence. It is the ultimate tool for neutralizing risk and for building a foundation of wealth, health, and wisdom that is designed not just to survive, but to flourish over the long term. It is the single most powerful mental model for transforming the inherent chaos of the world from your greatest enemy into your most valuable ally. Mastering the mathematical and intellectual framework of the margin of safety is the first half of the equation. It provides the what and the when. It gives you the logical structure to identify an opportunity and the trigger point at which to act. But it is useless without the psychological fortitude to execute it under extreme pressure. The battlefield where this mental toughness is tested, where your rational calculations collide with the raw, primal emotions of the crowd, is the stock market itself. It is an arena of fear and greed, of panic and euphoria, an entity Warren Buffett personified with a single powerful name, Mr. Market. Understanding your bipolar business partner, learning to disassociate his emotional price from the business's logical value, and weaponizing his manic-depressive mood swings is the essential next step. It is the art of emotional arbitrage. To deconstruct that psychological operating system, to learn how to master your own temperament and exploit the temperament of others, click on the video on your screen now for a full breakdown of the Mr. Market mental model.